Thank you very much, Zhang Yang. I should mention that Martin Souchier is a graduate student at Stanford, and he's fantastic. So keep an eye out for him. You probably already know Adrian and Matt. I should also say, Adrian is in the Q&A. So if you have any burning questions, just feel free to type them right away. This is still a very young project. So any feedback, any comments, any thoughts you have are very, very welcome. Okay, so the motivating question for this project is a very general one, namely, how do exchange rates affect aggregate demand? And so there's three traditional channels we could think about, and they're called the real income channel, the expenditure switching channel, and the balance sheet channel. And let me just give you a broad overview of what these channels are. So the real income channel was quite prominent in the literature in the 1960s. And it captures the idea that a depreciation of the exchange rate raises import prices relative to prices of domestically produced goods, and hence reduces net income real income of domestic households, because they now have to expend more to buy imported goods. And that then reduces their overall spending, including spending on home goods. Okay. So this means exchange rate depreciations, according to the real income channel, would reduce aggregate demand. Now, this channel, despite its prominence in the 1960s, is basically absent in textbook New Keynesian small open economy models that typically have a representative agent. And instead, the only effect that is there in those models is an expenditure switching channel, according to which, in response to a depreciation, you reallocate more spending towards home goods, which have become relatively cheaper. So it's kind of a substitution effect. And those New Keynesian models then have also been extended to allow for things like balance sheet effects. So what we like to do in this project, we like to integrate heterogeneous agents into an otherwise off-the-shelf New Keynesian small open economy model. And we want to see what that does to the transmission of exchange rates to aggregate demand. And what we're going to find is that this actually brings back the real income channel with the same intuitions that people had already in the 1960s, but now in sort of a micro-founded modern macro model. And we're going to show you that this can actually lead to contractionary devaluations. And this has important implications for monetary policy transmission, as well as for exchange rate management after capital flow shocks. Okay, so I'm not going to bore you that much with an overview. I'm just going to give you the roadmap and then go straight into the presentation. So what I'm going to do is I'm going to first introduce the model, which, as I already said, is basically a standard Galli-Monticelli model, but we're going to swap out the representative agent household side with a heterogeneous agent household side. And then we're going to use that model to first study pure exchange rate shocks. Think of, capital outflows as our prime example. And then we're going to think about a monetary transmission. Now, this is interesting because obviously monetary policy also affects exchange rates. And so some of the themes that we're going to see in the second part are going to reappear from monetary policy as well. Now, one key statistic, key elasticity that's going to play an important role for exchange rate shocks and monetary policy is going to be the elasticity with which agents do expenditure switching. It's going to be a substitution elasticity. And so I'm going to have just one slide for lack of enough time. I'm just going to have one slide on what we think is that elasticity and why we think it's probably very small in the short run but might be larger in the long run. And then with that out of the way, I'm going to end by just giving you a flavor of some of the things we can do then once we laid out this model. For example, we can study a combination where we have a capital outflow shock, and then ask the question, how should monetary policy respond to that if it wants to stabilize output? And it turns out that the answer is actually, more tricky than you might have thought. All right, so let me jump straight into the model. So this is a discrete time model. It's a small open economy model. And for simplicity, we're going to work with MIT shocks, small MIT shocks. So strictly speaking, that means no aggregate uncertainty. But if you keep in mind certainty equivalence, what this really means is that we're solving for impulse responses to different kinds of shocks, monetary policy, capital flow shocks, et cetera. There's two kinds of goods here. There's home or domestic goods labeled by H. They're produced at home and they're sold at a price PH at home. and at a price PH star abroad. And throughout this talk, I'm always going to denote variables abroad with a star. Okay. There's also foreign goods, capital F. They're produced abroad and their price at home is PF. Now, these two goods are consumed in bundles, and we're going to denote the price of the domestically consumed bundle by capital P, so that's the CPI. And we're going to normalize the price abroad to 1. We're going to allow for nominal rigidities. Now, in general, these could be nominal rigidities in prices and wages, but for today, we're just going to focus on nominal rigidities in prices. It gives us a bit of analytical tractability. And we're going to allow for 2 different pricing paradigms, namely, producer currency pricing, as is assumed in the standard Galli-Monticelli model, and as dollar currency pricing later on, which has become quite prominent in the literature in the past few years. Now, the crucial deviation from Galli-Monticelli that I want to highlight is that we're going to swap out the household side. So we're going to assume that there's a mass 1 of domestic households, and these households are subject to uninsured idiosyncratic income risk. So they have to do, precautionary saving, and you have nonlinear consumption function and all the good stuff that you have might have already seen from closed economy heterogeneous agent models. And in addition to that, and that part is standard, we're going to assume that there's a large mass of foreign households. All right, so these foreign households, we're going to assume that they have a fixed real consumption bundle C star. But these domestic households, they're not going to have a consumption bundle that's constant. Instead, they're going to solve an intertemporal intertemporal utility maximization problem. They maximize discounted stream of utilities over their consumption bundle CIT. There's some risk aversion parameter sigma here, and there's some labor supply disutility V. And so what do these guys earn? They earn their idiosyncratic productivity times the real wage times the number of hours they work. And we're going to assume that they all have to work the same hours. This comes out of a micro foundation for wage rigidity later on. It's not crucial, but that's just a simplifying assumption that comes in through wage rigidities. And what do they do with that income? They can save it and they can consume it. We assume that they are subject to a simple borrowing constraint of 0, also something we can easily relax. And then at the end of the day, we aggregate all individual agents' consumption bundles into one big aggregate consumption bundle of home households, and that's going to be denoted by capital CT. Now we're going to compare that heterogeneous agent economy to our sort of benchmark Galli-Monticelli-like economy. And in that economy, we're going to have a representative agent, and we're going to have complete markets across households as well as across countries. Now, the fact that markets are complete across countries, that is in line with Galli-Monticelli, but it's not going to be very crucial for our results. In fact, the results are going to change very, very little if we assume incomplete markets across countries. And so the hallmark equation that comes out of that representative agent model is, of course, the Euler equation, which does not in general hold in the heterogeneous agent model. Now, once we have those bundles figured out, the C star and the CT, we then can compute how much of those bundles actually spent on home goods. And that's going to depend obviously on the relative price that these agents see of home goods relative to their bundle. And of course, also on the substitution elasticity that is incorporated in their preferences. We're going to assume that the substitution elasticity of home agents is called eta, and the substitution elasticities of foreign agents is gamma. These could potentially be different, could be the same. We're not going to take a stance on that, but it's important for us to allow those to be free parameters, and they're going to play an important role later on. Now, once we have CH and CH star figured out, that gives us entire aggregate demand for home goods. These home goods, we're assuming, are produced simply by a linear production function in labor. And because this is a demand-determined economy, the sum of these two consumptions will just pin down what aggregate output is in the model. Now, let me tell you about prices and exchange rates in this model. So there's a nominal exchange rate denoted by curly E and a real exchange rate denoted by Q. And we follow sort of the macro convention that an increased value for those exchange rates reflects a depreciation of the exchange rate.
Hey, Ludwig, I have a clarification
yes.
about the previous slide. Could you go back to page 5? So you are saying that the productivity is different across different households as indexed by E of IT, but the function is still N. So are you assuming the integral of E to be 1, like in some sense?
Yes, exactly. So the integral of E will be equal to 1. And that's sort of a normalization that we'll make. And so all that means is that when we know aggregate labor earnings, W divided by P times N, then that gets split up across different households depending on what their idiosyncratic productivity draws in that given period. I hope, does that make sense?
Yeah, it does. One more question. So it seems every household's intratemporal choice between the two goods are identical, right? They have different levels, but their choice.
Yes, that is absolutely true. We have experimented with relaxing that and making some households, especially poorer households, to have a consumption basket that's more heavily tilted towards tradable goods. It turns out that doesn't really change our aggregate results. That's why we moved away from that, but it's certainly something you can do. Yeah.
Okay, thanks. Please go ahead.
Thank you. Perfect. Then we use a very, very standard formulation for the nominal wage rigidity. This goes back to work by Ercik and co-authors, as well as our heterogeneous agent generalization of their work. And essentially, nominal wages will increase here whenever the sort of the wedge in the average intertemporal optimality condition of households is large. So for example, when they need to work a lot, unions on their behalf will ask for higher wages. It's not going to play a crucial role. That's why I don't want to get bogged down here, but it is a very standard formulation of nominal rigidity. Now, in contrast to the nominal wage rigidity, for today, we're going to assume flexible prices. So we're going to have that imported goods at home are priced at just the nominal exchange rate, and that domestic prices of home goods are just a constant markup over nominal wages. Now, for in terms of export prices abroad, we're going to go for now with producer currency pricing. Okay, so this means the law of one price holds for home produced goods. So PH star, the abroad price of home goods, is just going to be equal to PH translated into the international currency. And we're going to allow for dollar currency pricing later on. Finally, last slide on the model, we're going to have that there's a domestic central bank. And as a standard, it's going to set the nominal interest rate at home. Now, for today, we're going to assume that it actually does so in a way that it targets a specific path for the real rate. Now, what is this really doing? It's essentially a Taylor rule that has a coefficient of 1 on expected inflation. That's really what the constant real rate rule here captures. You can obviously allow more general Taylor rules. Turns out that all this will do is will complicate our analysis, but the insights will be exactly the same. So that's why I'm going for now with this real rate rule. Now, there's also a world interest rate, and we're going to, for simplicity, assume that it's already risk adjusted. So this means that shocks to this world interest rate, I star, sort of have the feeling of risk premium or UIP shocks. Okay. And once we have that I star path figured out, we can solve for the real exchange rate path using the UIP condition, which we assume to hold here. And so basically the gap between the domestic real rate and I star will give us, how much expected depreciation in the real exchange rate there is in the model. Okay, last thing on the model, obviously these agents, they're going to have to trade some kind of assets. After all, they're doing buffer stock saving. We assume that the assets they are trading are basically claims on firm profits. These firms make profits because they charge a constant markup. And the capitalized value of those profits is going to be noted by V. That's like the stock market value here. And so asset market clearing just says that the assets that agents demand have to be equal to the stock market V plus any positive net foreign S position that they might have. In the steady state, we're going to assume that that NFA is 0. Perfect. Now, I'm not going to bore you with calibration details. Just let me highlight 2 things that for some of you in the literature might actually kind of be useful. First, we're going to allow for general eta and gamma. I already mentioned that. And we're going to have in mind that these eta and gammas are probably relatively small in the short run, but maybe larger in the long run. And this is something that later on I'm going to show you how you can capture it in our model. And the second thing I want to highlight is that this heterogeneous agent model is already stationary. So we don't need any other tricks to make it stationary and then run with that. So for example, you don't need, say, a debt elastic interest rate, which is one of the standard tricks that people in this literature have been using. So I think that's kind of a nice advantage of going the heterogeneous agent route. All right, so I'm going to take this model now and then feed in shocks to the exchange rate, by which I basically mean, think of capital flow shocks, right? Suddenly capital leaves the country, I star essentially increases. What happens? Okay. And while this happens, we're going to assume that monetary policy so far does not respond in the sense that it keeps the real interest rate constant. Later on, I'm going to actually show you what happens and how monetary policy could possibly respond to this. But for now, we're just going to assume it's constant. Now, this means immediately from the UIP, we know that the real exchange rate has to depreciate. And this also means that relative prices of home goods relative to the price indices of home or foreign agents have to fall. And so this immediately means if I write down the goods market clearing condition, both home and foreign households will want to substitute towards home goods. And this, in fact, is almost everything that's going on in response to this shock, except that overall home consumption can move around as well. In a particularly instructive case where this is not happening is the representative agent model, and their home consumption is not moving around. So all that's happening in the representative agent model is just a substitution effect away from foreign towards home produced goods. Okay. So in that model, in the representative agent complete markets, constant real rate model, consumption of home agent is a constant. We know already it's a constant from the Euler equation, right? Because R is constant. And we also know they can't shift around because that would have to be due to wealth effects, and those are insured in a complete markets world. And they're going to have a tiny effect in an incomplete markets world, so that doesn't change very much. And so in this model, aggregate demand is just pinned, and hence aggregate production is just pinned down by this equation, which if we linearize, we get a very simple expression. We get that the output response at day t is proportional to the induced depreciation of the real exchange rate at day t. And that proportionality is basically related to how much expenditure switching is going on, basically to how much, how large the substitution elasticities eta and gamma are. Okay. And one nice way to write this equation that we're going to like a lot, and we've used in other work as well, is to stack these impulse responses into vectors. So dy will now be a vector of all the responses of output in the different periods, and dq will be a vector of all the depreciations of the real exchange rate across periods. And then if we denote by chi, and this looks like an x, so it's a bit like expenditure switching. We note by chi the combined elasticity of home and foreign expenditure switching. We basically get the very simple expression for output, namely that it's proportional to Q, and the proportionality is related to chi, which is the expenditure switching elasticity combined for both home and foreign agents. Now, this is obviously a very stylized model, right? Consumption does not move here. So you might wonder, okay, what happens in a general heterogeneous agent model? Clearly there it should move, right? Because in a heterogeneous agent setting, we all know that NPCs are high and agents respond to income. So let me jump there right now. So with heterogeneous agents, aggregate consumption does depend on the real exchange rate. And the reason that this happens is because both real wages as well as real dividends depend on the real exchange rate. So why is that? Well, holding aggregate Y fixed, the real value of aggregate income falls when when the real exchange rate depreciates, because the relative price of home goods falls. And the same happens for dividends. Again, there's the same object that shows up here, which is the real value of aggregate income. And so one way to actually write aggregate consumption as a function of Q in the best possible way is to write it as a function of real aggregate income. And it turns out that once you know the impulse response of real aggregate income, that's all you need to know in order to compute the impulse response of aggregate consumption. And for anybody who's sort of versed in heterogeneous agent models, the reason for that is that once you know that path, you know aggregate labor income, you know aggregate dividends, and therefore you know how much every agent will earn depending on their idiosyncratic income draw, and how much assets will be worth at every point in time. And once you know this, you can figure out all the policies, you can figure out all the distributions, and after some computation, you can figure out that mapping from the path of real aggregate income to aggregate consumption.
Ludwig, here's a clarification question. Don't you also need to know the distribution of holdings of the wealth in order to?
Yeah, so exactly. So you know the holdings of wealth at date 0, right? We assume that there's some steady state that was there before the shock hit. And then at every point in time after date 0, the wealth distribution is obviously endogenous, but it's precisely endogenous, right, to the policies that you choose in response to changes in the path of real aggregate income. So it's really that object that will shape the wealth distribution over time. And once you give me the path of that object, you know how the wealth distribution will change over time, how policies will change, and hence how aggregates like aggregate consumption will change.
Got it. Thank you. Here is another question from Veronica. Why are dividends responding to exchange rate? Is this because they can only hold domestic assets, or would it change if agents had the optimal international portfolio?
So obviously, if they were completely diversified in the world, then that might look different, because then they might own foreign agents as well. For now, as I introduced, it is indeed the case that we assume that these agents hold claims on profits of domestic firms, and I think that's a reasonable starting point given evidence on home bias, and that's why these will respond to exchange rates. But note, they respond to exchange rates because of this relative price moving around, right? The real value of dividends will move around, and precisely because when there's a depreciation, right, pH might not change, but capital P will suddenly become more expensive. The index will become more expensive. That's why real dividends will in fact be affected. I hope that makes sense.
Yeah, thank you.
Thank you. Perfect. So now with this description of aggregate consumption in place, we can actually use it to linearize the model the same way we did before, using the home goods market clearing condition. And to do that, all we need to know is what the derivatives of these curly C's are. This is an object we have used in previous work of ours. So I'm just not going to go into that much detail, but basically you can write down the derivative of that, which is a big matrix, a big Jacobian. And we call that intertemporal MPCs because it kind of plays the role of an MPC in this model, and it captures basically all the cross derivatives of what happens to consumption at date 5 when, say, real aggregate income changes at date 10 or at date 2, etc. Okay. Now with that, we can write down in vector notation, in sort of stacking all impulse responses into vectors, an international Keynesian cross, which is a generalized version of the equation we had before. So what's going on here? Basically, output is still determined by expenditure switching, but it's also determined by aggregate consumption. Now that aggregate consumption used to be 0. In the representative agent model, that is 0. But it's no longer 0 here. And in fact, here it will fall because of when the exchange rate depreciates, because of a loss in real income. This is the real income channel that I mentioned in the introduction that comes back. But it might rise due to a Keynesian multiplier effect. You know, when aggregate incomes rise, people's spending rises. So there's 2 effects that are new here in the heterogeneous agent model that were not there in the representative agent model. Now we can collapse everything into one equation, and we show, and this shows that basically output is now the sum of all these 3 components: real income, expenditure switching, and this Keynesian multiplier term. Now, the entire heterogeneity, you know, all the buffer stock saving, you know, the nonlinear consumption functions, the wealth distribution, all of that is summarized in this M matrix, in this matrix of intertemporal MPC. So once you know that matrix, you can evaluate that equation. And in particular, if you gave me a different household side, say that, you know, a representative agent household side, you can give, you know, I can give you an M that corresponds to that household side. So for the RA model, that would be M equals 0. And in fact, right, if you remember, if I cross out these terms, I get back our standard, you know, RA formula for the expenditure switching effect. And in fact, this is all there is in the representative agent model. Now let's compare, let's compute these channels. And in particular, let's compute these 2 channels that are in some sense the partial equilibrium channels of the heterogeneous agent model, and compare that to what happens in a representative agent model. And then later on, we're going to add the endogenous multiplier that depends on the endogenous income response, dy. Now, in our representative agent model, if you remember, the only thing that was going on was expenditure switching. So that's the only line that's positive here, or non-zero here. The real income channel is absent. In our heterogeneous agent model, that's no longer true. Now we have a real income channel that is in fact negative. So our model sort of successfully revised that real income channel. It's negative. And the expenditure switching channel in the heterogeneous agent model is the same as it was before. Now what happens, so this is our partial equilibrium, you know, fixing aggregate y and not thinking about this multiplier effect. But what happens if you take that multiplier added to the picture? Turns out that that depends on the aggregate amount of expenditure switching, on that expenditure switching elasticity chi. And an especially clean case for that chi turns out to be chi equals 1. In that case, and this is kind of an interesting result, in that case, actually, in general equilibrium, the output response in the heterogeneous agent model is exactly the same as the output response in the representative agent model. And this is despite the fact that these have very different channels that are operating. You know, in the heterogeneous agent model, there's a real income channel, there's a multiplier channel, neither of which are there in the representative agent model. So in other words, heterogeneity in that chi equals 1 benchmark case is irrelevant for the output effect of exchange rates. So why is this the case?
I'm just wondering if the previous result is approximate or not. It seems to me it's not, right?
It's not approximate. It's an exact result. Yes.
Right.
It's a formula result. Yeah.
Follow-up question. Could you display again what chi is to remind us what this equal to 1 means?
Chi is the sum of eta times 1 minus alpha plus gamma, where eta is the substitution elasticity of home households and gamma is the substitution elasticity of foreign households. I'm going to tell you what range for parameters, what range of values we think is realistic for chi in a bit. But for now, we think, you know, I'm just going to tell you, we think it's pretty low in the short run. In the long run, it'll be much larger. Okay. And what matters for most of the experiments here is really the short run elasticity.
Okay, thanks.
Nevertheless, we think this is a really interesting sort of benchmark result for the study of, you know, open economy, heterogeneous agent New Keynesian models. So what's going on? So let me display all the channels, including the multiplier channel and the total response. So you see that in this case, where chi is equal to 1, the total response is the same in the rep agent and in the heterogeneous agent model. And what's going on is that the multiplier effect completely and perfectly offsets the real income channel. And that's why the real income channel does not do anything in this benchmark case. To put it differently, in the representative agent model, when we feed in our I star shock, which depreciates the real exchange rate, that only acts via expenditure switching on CH and on CH star. Now, if I switch on heterogeneous agents here, I get two more channels. I get a multiplier channel from higher output through higher MPCs on CH, on home spending, and I have the real income channel, which all else equal would push CH down, home consumption down. And it just so happens that at chi equals 1, those two channels perfectly offset each other. And now you already see from this picture what would happen if we changed chi, right? For example, if we reduce chi, then this expenditure switching channel becomes less relevant. Now the real income channel is still the same, but because we make expenditure switching smaller, the output response will be smaller, and hence the multiplier effect will be smaller. And so suddenly the real income channel actually materially influences home consumption. And this is what you see in this plot. So with chi smaller than 1, the total response in black here is suddenly smaller in the heterogeneous agent model than in a representative agent model, and even dips negative after a while. And the main reason for this is that now the real income channel is no longer offset by the multiplier effect and basically drags down the output response in response to that depreciation. Now, another way to see this is to look at consumption. Now, remember, in the representative agent model, consumption did not change. It's dead flat at 0, irrespective of chi. In the heterogeneous agent model, with chi less than 1, it turns out that consumption actually falls in response. And again, why is that? Because the real income channel, it's like a real income loss that these households experience that pulls down aggregate consumption. They need to now, if they import TVs from abroad, they now need to pay more for those TVs, so they have less money to spend at home, right? That's the intuition. And that's imperfectly offset by the multiplier effect. And that means the overall consumption response is going down here. And we think that's actually quite nice, because that is exactly the correlation that you need to solve the Backus-Smith puzzle. And I think this is a nice sort of complementary mechanism to some of the other mechanisms that have recently been proposed to solve that correlation. Now, if chi is sufficiently small, it turns out that we can get a contractionary devaluation. So not just consumption is falling, but also aggregate output. And you see this here in the left plot. When we have very low values of chi, it turns out that the output response is actually below 0. You get a recession in response to a contraction, in response to a depreciating real exchange rate. This is obviously not happening in the representative agent model, where it's always a positive response because there's no real income channel. It's all expenditure switching, and that's always positive. And we think that's an interesting result that you can get here. And it turns out that when we have a richer model that actually matches the elasticities that we see in the short and long run in the data, this is a result that will survive. So this is not just an artifact of assuming crazy low elasticity. Now, so far, this is all producer currency pricing. And you might wonder, what happens with dollar currency pricing? Isn't that, maybe this is something that's relevant for a lot of countries? And so we can evaluate this by simply assuming that export prices faced by home exporters are now constant sticky in the international currency rather than sticky in the domestic currency and then just trade at a flexible price abroad. Now, this is actually kind of interesting. This gives rise to two effects in our heterogeneous agent model. Now, there's the standard effect that you all know, which is that if I assume that dollar prices of export goods are sticky, then, or dominant currency prices, then there's obviously less expenditure switching by foreigners, right? If the price doesn't change, why would they change their expenditure? And so this will, all else equal, bring down the output response, right? This is why depreciations are less expansionary with DCP. Now, there is, however, a potentially offsetting effect, which is the profit effect, right? These exporters that sell at higher prices abroad now, when the exchange rate depreciates, they earn greater margins. And so dividends rise. And depending on who's earning those dividends, that might actually boost demand for home goods. And this second effect is new. This is not something you typically get in a representative agent model. And the magnitude of that effect depends on who owns these exporters and whether these exporters, say, hedge their currency exposure. And I'm going to show you what happens for both of these effects and for two cases of elasticities, one with small elasticities and one with large elasticities. And it's going to be striking how they differ. So let's start over on the right here. So this is the case with large elasticities. And in particular, the foreign substitution elasticity gamma is quite high. It's a 1 here. So this means, with large elasticities, even in our model, you get that with PCP, a depreciated exchange rate is expansionary. Now, when we switch on DCP, look at what happens. The dark blue line, that gives you the standard effect. We go all the way down here. And this reduction is entirely because now foreigners do less expenditure switching, or in fact, no expenditure switching, because the prices they face of domestic exported goods are sticky in dollars. Now, let's switch on the second effect, the profit effect. Now, that I said already, right? That pushes demand up. And indeed, it does push demand up, and the light blue line shows you this. But that's just a mild effect compared to the huge reduction coming from the standard effect. Now, that huge reduction relied on having a large gamma. Now, what happens if these elasticities, especially gamma, are already low? Now, then that reduction from our green PCP line, which is now negative, because for those elasticities, we get a contractionary devaluation. You actually don't have that the dark blue line is that much smaller. In fact, it's not much smaller at all. And so when you add the second effect, the profit effect here, it turns out that it can actually go the other direction relative to PCP. It can actually slightly lift the output response. Now, we think that's an interesting conclusion that you get from having heterogeneity together with dollar currency pricing. All right. So yeah,
there's about 10 minutes left.
Perfect. Thank you. So far, I've explained to you what happens in response to capital flow shocks, and we've seen that they give rise to real income channel, and that channel can be potentially large enough to cause a depreciation to be contractionary. Now, what I'm going to talk about next is monetary policy. Now, obviously, monetary policy also moves exchange rate, so it's kind of natural to ask, what happens when with monetary transmission in an open economy setting with heterogeneous agents. And we're going to study this again by sticking to our real interest rate rule. And again, the Taylor rule is very similar. It's just more analytically tractable to shock the real rate directly. Now, I'm not going to go through all the details, but there's going to be a relatively similar international Keynesian cross equation where we're going to have the same, three usual suspects. We're going to have an expenditure switching channel, a real income channel, and a multiplier. But now we're also going to have an interest rate channel, which is essentially intertemporal substitution induced by the monetary policy shock itself. And instead of going through the math, let me just show you a picture. Okay. So in response to, say, monetary easing, we're going to have that the exchange rate depreciates, and that depreciation itself has all the effects that I talked about before. So all that analysis, starting with the depreciation of Q, is exactly the same. The only new effect now is that there's an interest rate channel, which moves home consumption. And that one is new. Now, if you're familiar with the closed economy heterogeneous agents literature, you know that this direct interest rate channel is what's weaker in a heterogeneous agent setting relative to a representative agent setting. This was, for example, one of the main insights of Kaplan-Malviolante or Ivan Werning's 2015 paper. And for that reason, it's already intuitive that we might not get the same neutrality result for chi equals 1. It might not be the case that HA is really equal to RA, and in fact, it's not. But it turns out that there is still a neutrality result, and we think that's actually kind of interesting from a theoretical angle. It's just that that neutrality result is now there for a slightly higher chi, namely for chi equals 2 minus alpha. 2 minus alpha is essentially the chi that corresponds to a Cole-Opsfeld case. I'm not going to go into the details of that result, but it's kind of a neat analytical result characterizing open economy monetary transmission with heterogeneous agents. And again, when you deviate from that result and you assume a smaller chi than the benchmark result, chi below 2 minus alpha, you get that the output response in a heterogeneous agent model is below the output response in a representative agent model. And and even more on that, it's not just smaller on impact, but it's also turning negative after a few periods. So if you look at the black solid line here, it's actually turning negative. And that has a very strong intuition. Basically, what's going on here is that a reduction in the domestic real interest rate does stimulate the economy. It raises output on impact. But over time, it actually crowds out output. It reduces output in the future. So there's sort of a stealing demand from the future effect of monetary policy. And this is driven by two things. One, it's driven by increased import prices. Now, if you buy that TV, it costs you more. So imports rise. Import, in units of a local currency. And at the same time, agents want to do intertemporal substitution. So they front load their spending. And again, that means more spending initially and less spending in the future. And both of these effects are there when chi is small and when obviously this is an open economy. In a closed economy, this would not happen. Okay. And so what you get is that basically there's demand reallocation from the future to the present. And this is an effect that in different models, people have found in closed economy settings. But what's really striking about what's happening here is that monetary easing can steal so much demand away from the future that actually overall, if you compute the present value of the output response, it might actually be negative if chi is sufficiently small. So this basically emphasizes that that in a heterogeneous setting, agent setting, with an open economy, you can have a sort of stealing demand from the future effect that's even greater than what people have found in the closed economy settings. All right. So far, I've talked about exchange rate shocks. I've talked about monetary policy shocks, and in both cases, we found these interesting results for relatively small elasticities chi. We found contractionary devaluations for capital outflow shocks, exchange rate depreciations, and we found the stealing demand from the future effects for monetary policy when chi was low. So this obviously begs the question, what is that chi? You've all been assuming that it's low, but I don't even know what it is. So chi, right? Remember, it looks like an X. It's like the expenditure switching elasticity. So how high should that be? Now, when we try to parameterize this, it turns out that there's a bit of a problem here, right? Macro time series papers typically find very small elasticities. Think of exchange rate disconnect, for example. But the trade literature, usually using evidence from the cross-section, typically assumes quite high trade elasticities, maybe bigger than 3. And so Kim Rule has dubbed this the international elasticity puzzle. And so how do we resolve that? How do we get a consistent structure for substitution into this model. And so the way the thing we're doing here is we've come up with a simple model of delayed substitution that actually does a very good job of matching both small short-run elasticities and large long-run elasticities that explain why in the cross-section we find large elasticities, but in the time series we find smaller elasticities. And we use our model and calibrate it to match evidence from a recent and very nice paper by Borm, Levchenko, and Pandalay Nayar. Not going to have time for the details here, but basically, what's happening is that these agents want to, do substitution, but they can only do so if they're, tapped by a Calvo ferry, and that sort of slows down the adjustment process. Very simple model, but it actually fits the data very well. Okay, so to conclude my presentation, I want to do the following simple experiment. I want to put myself into the shoes of a policymaker in a country that suddenly is hit by unexpected capital outflows. So this is like a positive I star shock. The exchange rate depreciates, and we know already with low chi, the shock itself will be contractionary initially. And so this raises the question, what should you do as a monetary policymaker? What should I do in this case to stabilize output? And now seemingly there's no good option on the table, right? Let me give you the typical rationales that people tell you. First, the depreciation is the problem, right? It's a contractionary devaluation. So you get rid of the depreciation, maybe you get rid of the problem. How do you get rid of the depreciation? You have to stabilize the exchange rate. You have to hike interest rates, right? That would be rationale number one. The second rationale would be, oh no, the recession is the problem. And you have a recession, that means you need monetary easing. Even if that means a further depreciation of the exchange rate and the fact that you steal demand from the future by having agents do more spending now and worsening the current account deficit. So what we're going to do in the last minute or so, we're going to investigate both rationales and see if through the lens of our heterogeneous agent model hold any water. Okay, let me start with the first one. Okay. So these plots in blue show you the shock itself without any monetary response, fixed real rate. So in blue, you see, I star denoted here as R star goes up, and that causes the exchange rate to depreciate, and that causes output to fall on impact. That's the contractionary devaluation right there. Now, if we want to fight off the depreciation, what we want to do is we want to hike rates, right? We want to hike domestic real interest rates in lockstep with I star. And by the UIP, this essentially eliminates any movements in the real exchange rate. Now, you might have thought, okay, maybe that solves the problem. But it turns out, and look at the right plot, it turns out that the output response is actually even worse on impact than before. It takes a few quarters, then it kind of gets better, but initially it actually worsens the problem. Now, what's going on here? Basically, we're replacing one evil, namely the contractionary devaluation, with another, which is contractionary monetary policy. And that's because the interest rate channel is still active. So you're still doing contractionary monetary policy. This has not changed, even if the exchange rate is basically set to zero. Now, if you fight the recession, I'll be done in a second. If you fight the recession, imagine you do that by, say, stabilizing output instead of the exchange rate for the first year. Now, if you want to do that in the model, this requires a quite significant stimulus, quite significant cut in the nominal interest rate that really induces agents to spend more. And that is needed to balance off a further depreciation in the real exchange rate, which we know in and of its own would be contractionary. Now, you might say, okay, this kind of works, right? It gets output to zero, but the problem is once you stop with the policy, you actually get an even bigger contraction. And so it turns out that the policy you need, and this is the last plot I'm going to show you, the policy you need in order to solve the problem, in order to stabilize output after a capital outflow shock, is actually a very persistently small, persistently reduction in the monetary policy rate, which leads to a more aggravated depreciation, but that's counteracted by the stimulus effect of the lower monetary policy rate, and that turns out to stimulate an output enough to set output equal to 0 in all periods. All right, let me conclude. I have presented a very young and recent paper, so please give us your comments, that merges two sort of off-the-shelf textbook models. One is a heterogeneous agent model, and the other is a New Keynesian small open economy model, a la Galli-Monticelli. I've shown you that that gives rise to three things. First, a real income channel. Second, contractionary devaluations. And third, to this idea that monetary easing steals demand from the future. Thanks very much for sticking around and for having us. Thanks to the OIFM team.
Thank you, Ludwig. Would you like to stay a few minutes for questions? We're now going to open just for anyone to raise hands and ask questions.
Absolutely, yes.
Thanks. So if anyone has a question, please raise your hand on this participation board and I'll be able to call you. I guess I have a very basic question to start. This shows the fact that I'm not up to date on the Hank literature. So let's suppose we're in a different world, which I think is different from your model, in which people's consumption is linear in their income. In that case, even with a lot of heterogeneity in wealth and maybe market incompleteness, we're not going to deviate too much away from the representative agent benchmark. So could you point to me where exactly does this deviation happen? Is that in a nonlinear propensity to consumption?
So no, so it is actually in the linear solution. So everything I showed you was first order perturbations. So linearized, we linearized the model in aggregates. Mm-hmm. And the reason it shows up with a linearized model is that right, the linearized model does not imply that aggregate consumption is constant like it is in a representative agent model. You could have that aggregate consumption moves with domestic income, and so that does not require any aggregate nonlinearities. I can point you to something on the slide that shows that to you, but basically, the representative agent model is not the benchmark where consumption is linear in income. It's the benchmark where consumption is flat, right, where it doesn't do anything. And this is the equation I can point you to, right? This is a perfectly linear equation, right? Consumption, no. Forget that it's vectors, right? It's still linear, right? So the impulse response of consumption here is linear related to the response of real exchange rates and to the response of income, right? Now, these M's are some matrices, but these could be simple matrices. These could be, matrices that just have entries along the diagonal, for instance. So everything here is still linearized in aggregates. Now, obviously, all the nonlinearity that we have that you maybe have heard of in heterogeneous agent models, right? Think about curve, consumption functions, and assets, et cetera. That's all there. That will just shape what this M looks like. So this is where sort of that individual level idiosyncratic nonlinearity shows up. If that makes sense.
Yeah. Any other questions?
Then I guess I'll go for one that I've asked Ludwig before, but it would be useful to sort of discuss it again together. Do you want to give us a sense of how big do you think these effects are? So last time you and I chit-chatted about this, I was trying to distinguish effects of the exchange rate that applies to flow objects versus effects of the exchange rate that apply to stock objects. And the way you get a contractionary sort of depreciation normally is through an effect through a stock object, as in through foreign currency debt. And so one would imagine it's very big because it applies to the whole stock of debt. It'd be very useful, I think, to me, but also to the audience if you want to sort of speculate a little bit and entertain my question.
Yes, absolutely. No, I think this is a big question, and this is something that it's on our agenda to do and then put it into the paper. So two thoughts on this. I guess one important factor that will determine whether it's indeed a flow or a stock that is relevant for the balance sheet channel is, kind of the maturity of the debt, right? Like if you're forced to repay suddenly, you make all your payments in a depreciated currency, then obviously, right, it's very costly. Now, to the extent that these are sort of more longer term, longer maturity debt contracts in dollars, which I guess is maybe more the norm, then these payments are more like flow payments, right? And so then maybe every period you pay, I don't know, 10% of the stock, and then you have to multiply that with the depreciation. Our flows tend to be quite large. Like, our flow is essentially the share of imports, right? Or the openness parameter alpha. And so that can be quite large. But depends on the country, obviously. I'm not going to claim that, there's countries where balance sheet effects are definitely dominate the effects that we have here. And one of the things that we're interested in is actually trying to figure out, for which countries is this effect bigger, for which countries is, say, a balance sheet effect bigger. It definitely depends on the country. Yeah, I mean, I think that's, I guess one thing I could add is one maybe more recent development is that it seems to be that, banks in lots of emerging economies seem to try to match currencies now on both sides of their balance sheet. And so I don't know how much sort of net exposure there still is across countries from, say, dollar liabilities of emerging markets. Again, depends on the country, but in some, it's definitely less than it was, let's say, 20 years ago. And I think, it could still lead to, within country reallocation effects of wealth, but sort of maybe, for the country as a whole, it's maybe less relevant now, but this is pure speculation, and we will have to go and do the data work for that.
And one thing I may add, Matteo, and this is something that you may be able to help us with, is in our model, in order to figure out the magnitude of the balance sheet effect, we need to know not just overall exposures, so foreign currency debt overall, but also who holds the debt exactly. So for us, it really matters how big the MPCs are of the agents that have foreign currency debt, and that particular correlation is something that we would be really interested in knowing, and something that we could then match the model to in order to be able to quantify the relative size of the balance sheet effect that we talked about in the introduction relative to the real income effect that we.
I mean, we can talk more about this. I suspect that one interesting angle is going to be that the answer probably is different for the sovereign debt, for the corporate, non-financial, and financial sector, and loans might be something different. But think of like a stereotypical large emerging economy. Participation in the local currency debt for the sovereign has gone up a lot from foreigners. Not so much for the corporate market. I've worked on it. Jesse Schrager and Wang Xindu have worked on it. There's also a side on loans. There's certainly interesting data that you can bring to bear on this, but you have your hands full developing the theory. It strikes me more of a second step in a different paper, if referee 2 is listening, rather than having to sort of do a major exercise in the first paper where you've already done something pretty meaningful.
Thanks, Matteo.
So we have one question from Atanas Pekanov. So could you unmute yourself?
Hi, everybody. Thanks for a very interesting presentation. Hi, Ludwig. Just a question on this general equilibrium result. So I was wondering if I understood correctly, the multiplier effect doesn't offset the real income effect, but does that depend on the asset market structure? Because when I think about Kaplan-Meier and Violante, they get the high multipliers effect only from the two assets side, right? And also in your paper with the intertemporal Keynesian cross. So if you have other asset market structure, would that mean that the contractionary devaluation would not be achievable?
So let me answer it first analytically. if you have, so I guess your question about asset market structure is mainly targeted towards understanding, how high are these MPCs? Do we need, large MPCs for this to work or not?
Yes, exactly.
And it turns out that that even for small MPCs, as long as you're still in the heterogeneous agent model, you can get contractionary devaluations. It's just that you need chi to be very, very small. So from a sort of formal perspective, you can always get it. You just need chi to be very, very small. Now, the closer you are to a representative agent model, the smaller chi has to be. Obviously, you for this to be a reasonable cutoff, you need that for this contraction devaluation to happen for a reasonable chi parameter, you do need to target realistic MPCs and not have that MPCs are very small. Now we could do this with a 2-asset model. For now, we've actually gone a different route just because it's a bit simpler. We've used beta heterogeneity. It's another trick to get overall wealth to be high at the same time as high MPCs. I don't know if that answers your question, Athanas.
Yes, perfect. Thanks.
Thanks
a lot.
Hey, Ludwig, I also have one more question, or I guess it's a comment. So it seems to me that you are using a risk-free rate, the discount rate R, as a proxy for a discount rate with a risk premium, and you're deriving the exchange rate UIP condition based on it. So if we're thinking about a central bank lowering the interest rate, we're still talking about the same risk premium laden discount rate, correct?
So there's two, let me go back to our UIP condition. So just two types of interest rates, right? So the domestic interest rate we assume it's just a risk-free rate. And the international interest rate, we take to be the interest rate that the country sort of can borrow at. So this would be an interest rate that actually has a risk premium attached to it. Now, this is a first order model, right? So we're not going to have a literal microfounded risk premium, but in keeping with the literature, you can get sort of a sense for how a risk premium shock would work by basically allowing for a shock to the UIP condition. For us, we package that into I star, but you could say maybe this product is 1 plus I star, a constant, risk-free world rate times 1 plus some risk premium, or 1 plus a UIP shock or something like that. But we can't microfound the risk premium here, just to be clear, but we allow for the kinds of shocks that people have allowed for in the literature in this sort of simple form.
I see. So I did find your last result quite intriguing in that you're saying either raise or lower the interest rate would not solve the current capital outflow perfectly. So in that sense, if we do have a domestic interest rate policy, and in addition, if those policy could affect the domestic households risk premium, then we could imagine there being two levers to address that. Is this kind of the right intuition?
So I think, I would have to speculate because we don't have a domestic risk premium in the model. I think this would depend on how the risk premium enters the model. If household, for example, if households see both the risk premium and the risk-free rate, and enter in the same way, then I would imagine that maybe those two levers, if you could influence the risk premium, I guess, separately from the risk-free rate, which is, I guess, somewhat of a question mark, but maybe it works in sort of, with QE in the bond market. Then in principle, if they two, enter the same way, right? In principle, they're substitutable, so they won't do much. Now, if they entered in different ways, you would have two levers, but it's not obvious to me exactly how you could use that to solve this problem. Now, one solution that I know from my own work that it could apply here is obviously, foreign exchange interventions, right? That would be a way to control the exchange rate separately from controlling the interest rate. And obviously, capital controls is another way to do that, which has seen quite an interest in the literature in the last couple of years. Yeah.
Mm-hmm. Okay, thanks a lot. Is there any other question? So with this, I guess we'll conclude today's seminar. So thanks a lot, Ludwig. This is very fascinating results.